The Medical Properties Trust stock, MPW, is currently trading at $5.21 USD as of 12:26 p.m. EST, showing an impressive intraday gain of approximately 5.15%. Now, that significant pop in the price today, considering the prevailing sentiment around this stock, is the first thing we need to interrogate. The market's common expectation for MPW is generally one of deep caution and volatility, a narrative driven by ongoing tenant issues, primarily with Prospect Medical Holdings, and substantial debt concerns in a high-interest rate environment. Yet today's spike of over 5% goes directly against that dour expectation. This unexpected strength is largely tied not to a single blockbuster announcement, but to the slow, deliberate, and highly technical process of asset de-risking that is finally starting to show visible positive movement. The market is beginning to price in the successful execution of MPT's long-stated strategy to divest problem assets and secure new, more reliable tenancy, moving the narrative from one of existential crisis to complex turnaround, a crucial shift that many casual observers might have missed. The general belief about Medical Properties Trust is simple. It's a high-yield REIT that got burned by poor tenant selection, most notably the Prospect debacle, leading to a massive loss of investor confidence, a steep drop in its stock price, and the necessary but painful dividend cut. This belief isn't entirely wrong. The stock's performance over the last 2 years reflects exactly that stress. However, the deeper reality is that while the tenant issues are real, the company is actively and with increasing success working through the restructuring of its most problematic exposures. The most recent third quarter 2025 report, which was released a few weeks ago, actually paints a picture of a company stabilizing its operations even with a GAAP loss. The reported normalized funds from operations of 0.13 per share was slightly below expectations, but the market largely shrugged that off because the forward-looking guidance and strategic updates carried more weight. The core insight that's driving today's positive price action is the improving cash collections and the progress on the Prospect asset sales. Management confirmed increasing confidence in achieving an annualized cash rent target exceeding $1 billion by the end of 2026, which essentially signals that the core revenue-generating machine is not only intact, but being restructured for better future performance. This focus on future cash flow resilience, backed by concrete steps like the new lease agreement with NOR Healthcare Systems for the 6 California facilities, fundamentally challenges the narrative that the company is spiraling. The details of that NOR deal, a commitment to $45 million in annual cash rent post-stabilization, show tangible movement on the company's core problem, which is far more important than a one-time earnings miss due to impairment charges. The current trading dynamics for Medical Properties Trust stock are a battle between high short interest and institutional accumulation at suppressed valuations. The high intraday volume suggests a short-term conviction, possibly a mix of short covering and opportunistic buying. Institutional ownership is substantial, with major players like BlackRock and Vanguard holding large positions, though some have pared back shares in recent filings, indicating a degree of sustained caution. However, the overall long institutional value is still significant. What's particularly telling is the insider activity over the last year, which shows a net activity skewed toward buying, suggesting that those closest to the company's operations believe the current valuation does not fully reflect the value of the underlying healthcare real estate assets. For those engaging in self-investing and looking at a deeply discounted name, the internal belief from management, evidenced by the recently authorized $150 million stock repurchase program, is a powerful signal. Management essentially declared that they believe the MPW stock is one of the best investments they can make, a bold claim that backs up their strategy to use cash from asset sales to buy back stock at these depressed levels, increasing shareholder value for the remaining investors. This is the kind of aggressive, confidence signaling move that often creates tension between the shorts and the long-term holders. Looking at the business model of Medical Properties Trust, it is a specialized real estate investment trust that focuses on owning and leasing hospital facilities. Its portfolio is vast, spanning 388 properties and nearly 39,000 licensed beds across 9 countries as of the end of the third quarter of 2025. This global diversification, especially the strength in their European operations like the UK and Germany, has been a critical ballast against the domestic challenges. REITs, by their nature, are total return vehicles, distributing a high percentage of taxable income back to shareholders through dividends, which is what initially drew many investors to MPW. For those using online investment platforms or an individual brokerage like Fidelity or Interactive Brokers, MPW was traditionally seen as a high-yield anchor. However, the core weakness of a triple net lease model, where the tenant is responsible for property taxes, insurance, and maintenance, is the absolute dependence on the financial health of the operators. When a major tenant like Prospect Medical Holdings runs into financial trouble, as they have done, the contagion risk to the landlord becomes immediate and severe. The whole investment thesis for MPW over the last year has been about managing this risk and extracting value from the impaired assets. It's a complex situation that requires more in-depth research than a simple screen on Robinhood stock trading might provide. The recent operational shifts show MPT moving away from relying solely on problematic operators. For instance, the successful re-tenanting of facilities in Florida, Texas, Arizona, and Louisiana to new operators who are reporting improving performance trends is a small but important proof point that the underlying assets are valuable and operational. Furthermore, the total portfolio's trailing 12 months EBITDARM rent coverage has actually improved to 2.5 times, up from a lower figure earlier in the year. This metric, which measures the operator's ability to cover rent, debt service, and capital expenditures, is the single most important operational health indicator for a healthcare REIT. Its improvement suggests that outside of the highly publicized problem children, the majority of the portfolio is performing better than the general market gloom would suggest. This creates the primary tension for the stock. The market focuses on the tail risk of Prospect, while the company is quietly improving the health of the torso of its portfolio. This discrepancy is where opportunities and risks tend to be the most exaggerated. If you're managing a portfolio, perhaps using Schwab Intelligent Portfolios or any of the other intelligent portfolio options, the question is how much credit you give this operational improvement versus the remaining capital structure risk. Looking ahead, the future outlook for the Medical Properties Trust stock hinges entirely on 3 key catalysts. First, the finalization and cash flow ramp-up from the Prospect asset sales and re-tenanting, especially the NOR deal and the expected proceeds from the Connecticut hospital sales to Yale New Haven Health, which should fully repay MPT's debtor-in-possession loan. The second catalyst is the company's approach to its heavy debt load in a persistent high-rate environment. With total debt around $9.75 billion and weighted average interest rate around 5.38%, their ability to successfully manage or refinance near-term maturities will be crucial. The asset sales are essentially a debt reduction strategy in disguise, prioritizing liquidity and deleveraging over short-term FFO accretion. The third catalyst is the continued stability of their European segment, which provides a reliable, high-quality cash flow stream often overlooked in the U.S.-centric media coverage. The risk, of course, is that a worsening macro environment or regulatory pressure further destabilizes one of their remaining smaller tenants, or that the process of asset disposition drags on longer and at lower valuations than anticipated. The opportunity lies in the stock currently trading at a significant discount to its book value per share, which sat at $7.75 as of the last quarterly report. For a company valued below its hard assets, a successful turnaround means a potential re-rating to a multiple closer to its peers. We can summarize the expectation versus reality dynamic clearly. The expectation is that a messy, over-leveraged REIT with a major distressed tenant, Prospect, is a value trap that could face more dividend cuts or dilutive capital raises. The reality, as evidenced by the internal operational metrics and management actions, is that the core business is stabilizing, cash flow coverage across the portfolio is improving, and the major problem asset is actively being restructured through asset sales and new leases with an anticipated target of over $1 billion in annualized cash rent by 2026. This is not a guarantee of a fast recovery, but it changes the stock from a speculative short target to a deep value play where management is actively buying back shares. For those engaging in online investing, this shift in narrative from uncontrolled collapse to controlled, aggressive restructuring is where the real investment value proposition is built. The stock is reacting positively today precisely because the market is starting to trust the path to stabilization. Before we conclude, let me ask you, comment below whether you think Medical Properties Trust stock's debt situation or the remaining prospect assets pose the greater risk to the stock price over the next 12 months. Let's keep the discussion